Good morning and welcome to Bazaar Morning Call. I am Anuj, with me, Prashant and Sonia. Today is Friday, so obviously the energy levels would be a bit higher, right? For the market, the energy levels have always been high, despite the bit of a test of its resilience which has happened over the last couple of days. But the big question really is that, is this test now getting into a stage where perhaps even our market might have to just say, okay, I might be flunking this test? Because while yesterday you did see Indian market recover quite a bit and they did survive the global scare, the big moves are happening really in the money market, and it will be interesting to see the way the dollar is at dollar rupee is at 81 and the dollar index is at 20-year high. For how long can the Indian market survive this global risk off? That is a big question. The SGX Nifty will come up for you. It's a bit soft. And let's see if yesterday's low gets defended or not. Prashant, Sonia, hi, good morning.
Hi, morning, Anuj. Morning, Prashant. And the global risk-off is quite prominent, right? I mean, yes. It's pronounced, especially after what happened yesterday and through the course of this week. I mean, the US markets were down about over 100 points yesterday. For the week, the market is down 2.5%. And if you look at it for our own markets as well, FIIs or foreign investors have resumed selling in large amounts. So there was 2,500 crores of selling in the cash market yesterday. And put together, if you look at the last 5 or 6 trading sessions, barring 2 sessions, which is 19th and 20th, there's been large selling of over, 2,500 to about 3,000 odd crores. The only saving grace for our markets is that there is an outperformance in the mid-cap end of trade. So there's a lot of bottom-up stock picking that's going on there. The Nifty mid-cap index was up about 1% this week so far, outperforming the headline index. And a lot of stocks, non-index large caps, have seen big moves this week, whether it's, something like a KPIT Tech, Varun Beverages, Patanjali Foods, all at fresh highs, Page Industries at a fresh high as well, and something like an Ashok Leyland being the biggest gainer this week. So that has been the theme, right? The outperformance of the broader markets. Even if the headline index chooses to pause or see a time correction, do you reckon that there could be this stock-picking bottom-up movement in the broader markets?
I think that will be the trend, has been the trend for some time, but in between the market will throw out some of the weak players. I think the market is doing that, Sonia, right now. And for me, the data point that I'll watch out for, and this is the question that I put to Sunil Kaul as well yesterday from Goldman, is this FII selling. Because in the last 1 month, the rally that we had, a lot of FI money had come into India at the expense of China and a couple of other markets which had problem. Now, that money is momentum chasing market. If it doesn't get momentum, it doesn't care what your macros look like, it will get out. So, in last 5 out of 7 days, we've seen FIs actually sell. And the September number is now almost turning into negative territory. After a very good August, net in September, we're about to turn negative. And if this trend continues, September could be a negative month from the FI point of view. Not just that, there's been selling in the futures and option market, and in index futures, after short covering of last 3 or 4 days, yesterday 26,500 shorts were added, which has taken the net short positions back to over 60,000 contracts. Now, I know we keep saying that these shorts will provide fodder to the market to go up, and if the market doesn't fall, what if the market falls? That, I think, is a question which nobody wants to sort of answer, because everyone has just assumed that every dip will be bought and the market will just keep going up. Things can change, and the way currency markets are moving, just have to be a bit careful of what's happening here. I think the Nifty needs to hold the 50-day exponential moving average to stay in this uptrend. That level comes in at 17,350. So that's your Lakshman Rekha, if you want to call it. On the upside, the 20-day exponential moving average is 17,700. That will be the first resistance point. This is also that trend line, that falling trend line that we have been repeating ad nauseum. It's almost become the go-to level. It's almost like a magnet. Every time the market is going up or down from this level, it's attracting, the index back to that level. So 17,700, I think, is your fulcrum. The Bank Nifty, of course, is the index to track because that's the leadership pocket, but that has started to falter a bit over the last couple of days. The 20-day exponential moving average is 40,270. That is all important. If that goes, I think the Bank Nifty is in for another 1,000, 2,000 point correction if that happens. If not, then of course we'll take it from there. If you're a day trader, yesterday's range is something that you've got to keep an eye on, because it looks like we'll start somewhere around yesterday's low. If you protect it, maybe the market has a rally towards yesterday's high, who knows. But the fact is that things are looking slightly more muddled than they were, say, about 2 weeks back. Prashant, hi, morning.
Yeah, absolutely, Anuj. I'll just keep it very, very brief today. So equities continued their sell-off. Both the S&P and the Nasdaq were down, under 1% and over 1% respectively. The US 2-year, which is the most aligned to where the Fed wants the Fed funds rate to kind of be at by the time they're done with this hiking cycle, has crossed the 4% mark convincingly. The 2-year is at about 4.11%. The 10-year rose 18 basis points. That's a big one, to about 3.71%. The DXY index has now, it fell, by the way, but it went back up by close to about 111.3. The dollar always hurts. I mean, you know, they call it the dollar wrecking ball for a reason. It puts pressure on currencies. I mean, you've seen what happened to the yen, the intervention yesterday. You're seeing what's happening in other countries. I mean, the euro, for example. But these are countries with underlying problems as well. It's not as if these countries are doing very well. And, you know, the dollar rising is hurting currencies. There are underlying problems as well. But it's showing up in so many other places. Here in India as well. It's a real trade-off now with the rupee. What to do? Let it go for a while with the dollar so strong, or save your ammunition, because it's going to be a long, uncertain kind of year. So I think that's essentially the big talking point. Oil, it ended at about 90 odd. You know, the thing with the market here is oil being at 90, which is significantly lower than $40, $50 lower than where it was at the highs a few months ago. Is that the bigger macro positive for a market like India, which is such a large importer of the stuff, as compared to the dollar rising and global demand slowing down? So at least for now, I think that seems to be working. The other big kind of thing is, I think, you know, I put this out 3 weeks back, which is basically showing how India, amongst the emerging market pack, is perhaps the preferred choice, because so many other places in the world in that emerging market index is doing so poorly. But I think one gets a sense that, you know, it's well discovered, it's well recognized as well, this particular fact. So I think the direction will depend, this alignment with global markets, or, I mean, will we continue to chart our own path, will depend purely on flows, foreign flows. You know, that's a tough question to ask. At what point do foreigners have had their fill, and you know, money starts going back home? So I think those are questions we will have to kind of deal with as the days and weeks go by. But the outperformance, I think, has been the theme this year so far. 20% down in the S&P, more than that, and the market here in rupee terms at least is higher for the year. Sonia.
Absolutely. And you know, while we are talking so much about the global markets, in our own markets, the theme that has done really well this week is FMCG.
Yeah.
All FMCG stocks are up 4 to 7%.
The index is up 4.5% this week so far.
Absolutely. So that domestic consumption theme is intact, right? HUL, ITC, Britannia, Titan, all of them the biggest gainers this week. So we'll keep tracking sectoral themes and stocks for you. Of course, Tata Steel will be in focus as well after amalgamation of 7 of its subsidiaries. Accenture reported their earnings, so IT stocks in focus, lots to talk about. Let's kickstart the show very quickly. First up, we have some opinion coming through from Jonathan Garner of Morgan Stanley, who views the Fed outcome as unequivocally negative for Asia and emerging market equities. He continues to expect markets to move rapidly towards their bear case targets of 890 for the MSCI emerging market and 17,000 for Hang Seng. He says they do expect a trough in the market at around these bear case targets in a matter of weeks rather than months from now.
Okay, on to a quick macro view from Santanu Desgupta of Goldman Sachs. He says that they are raising RBI repo rate forecast to include a 50 basis point rate hike in September meeting versus 35 basis point previously, and a 35 basis point hike in December meeting versus 25 basis point previously, with upside risk to the forecast if commodity prices are higher in Q4 2022. He now expects 50 basis point of further rate hikes in 2023 versus estimate of 75, which would take the repo rate to 6.75% by April 2023. He adds their US economics team has revised the Fed fund rate forecast higher to 4.5 to 4.75% versus 4.4 to 4.25% previously, on the back of the hawkish FOMC. And this is where I think the big question is, because what is this terminal rate? We don't know, and everyone's raising it, and now you raise it to 4.25%. And at the time of Volcker, it went to well over 10%. So I'm not saying that it goes there. But the chart I presented yesterday as well, whenever the US inflation goes up and goes up, say, 7-8%, it needs to fall. The Fed fund rates have to go higher than the inflation for it to stabilize. So inflation really has to fall. If it remains sticky, then the Fed has to keep raising rates. So we don't know if this terminal rate stands here or not.
Okay, so just brace yourselves for more rate hikes, right? But there's so much happening in the money markets. The rupee hit a record low yesterday of 80.86. The dollar has climbed to a 20-year peak. So here's what you can expect purely for today. Bhaskar Panda of HDFC Bank says that a 75 basis points rate hike followed by a hawkish commentary from the US Fed has soured the mood across. The Bank of England's rate hike, Russia's gambit to hold the referendum in Ukrainian areas, crude prices and the Bank of Japan's intervention to stop yen depreciation. He says the news flow has already made a dent in the local markets as the dollar INR broke through 80 yesterday and traded within touching distance of 81. He also says that the mood across is still negative, though lower oil prices and comparatively higher growth should help the dollar INR. He expects the pair to trade in a range of 80.70 to 81.10 for the trading day.
Okay, and on the bonds, we have Bhaskar Panda saying that the Indian bond yields have rallied on the back of the global backdrop. He expects the 10-year yield to trade in a range of 7.3 to 7.35 for the day.
Okay, there are plenty of stocks to talk about this morning. Of course, we'll get to that in just a bit. But here's a quick snapshot of all that we're looking at today. There's Tata Steel, of course, tin plate company, Tata Steel Long Products, Tata Metallics. All of the subsidiaries will be, 7 of their subsidiaries will be amalgamated into Tata Steel. More on that in a bit. There's also Cipla on our radar on the back of positive news flow. And on the negative side, there's TRF, M&M Financial Services, TCS, Infosys and Glenmark that could perhaps open in the red.
Well, as inflation concerns soar in the U.S., the Fed hiked interest rates to its highest level since 2008 and has pledged more hikes to fight inflation. Let us now listen into some opinion coming in U.S. inflation concerns from the former Fed Vice Chairman Roger Ferguson, the former Dallas Fed President Richard Fisher, and Nuveen's Saira Malik. Listen in.
I think the market has caught up with the Fed as of today. I think the challenge is the Fed may find itself going maybe faster than it currently expects. And so I think that's a little bit of the dilemma here. They were clear yesterday about the message of higher, more quickly and for longer, and I think the market heard that. But now the incoming data, I think, will drive whether or not the Fed executes the plan as laid out or actually has to, turn even a little faster. So I think that's the dilemma right now.
I don't think they're going to stop. I think they are front-loading as much as possible. There is a lag, as you pointed out. Let's say you're a woman running a company. You're trying to figure out, do I accelerate my receivables, lag my payables, all the way up through CapEx and everything in between, inventory management, et cetera. That's why it takes time to work its way through the economy. That process is underway right now. Their reading is that the labor market is so strong. We have the Phillips curve is back. We have a wage price spiral, and they have a lot of leeway. And they're going to exercise that leeway.
Yesterday's FOMC meeting was a tough pill for markets to swallow, and I think this likely continues for 3 reasons that came out of the Fed. They're talking about higher inflation, higher interest rates, and higher unemployment. What we've realized is that inflation is going to be here for a while, and the Fed has to continue to increase interest rates. That is a headwind for equity markets. There's other areas that still are shoes to drop, such as earnings. We're seeing third quarter earnings estimates start to decline so far by about 5%, but still positive earnings growth for the rest of this year and through 2023 is a challenge for the markets, along with the strong dollar. I think it's just more challenging now even than it was a year ago.
Okay, those are views coming in on global markets. Now let's get one more in. Suresh Tantia is joining us now. He's senior investment strategist at Credit Suisse. Suresh, great to have you with us here on the program. Thanks very much. The flows here in India, the foreign flows especially, starting to sort of see some amount of not nervousness, not outright big outflows or anything, but they slowed down. The pace has slowed down. Yesterday we had somebody who was saying that flows into emerging market ETFs is starting to slow a little bit, which has been a big, active funds, we're not getting that much money in any case, but ETFs are also starting to see a slowdown. Do you think the big outperformance here in India will last, Suresh, or you think will essentially align to what the globe is doing?
I think definitely India is a bright spot when it comes to emerging markets. But at this point of time, you really can't fight this tsunami of interest rate hike and tightening policy that we are seeing across the board. Money is going back to US dollar and the home market in US, given the rising interest rate. Now, bonds are looking much more attractive compared to the equity market, and investors are worried about the currency risk. We have seen INR crossing 80 level against USD. So that's why I think it would be difficult to continue to attract inflows into the emerging markets. it's most likely that you will see further outflows from EM.
Okay, further out from EMs. That's interesting. Suresh, good morning. So, would that include India as well? Because we have seen a big amount of inflows all through August and the first fortnight of September as well. But the last couple of days, we started to see some selling.
I think you would see some outflows from India, especially as investors are now getting worried about INR depreciation. The interest rate, the differential between India and US are widening, and that could put further pressure on INR. And RBI is very hesitant to hike rate more aggressively compared to what other central banks are doing. So that might lead to some outflows from Indian equity market, especially as the market has done well and valuations are not cheap.
So, Suresh, hi, good morning. When you say outflows from emerging markets, including markets like India, what is your advice to an average investor watching you right now? Because the gains have been good, especially in pockets like financials, in the mid-cap space. Do you keep your powder dry, wait for a bit before investing? Do you move to cash? What is the most prudent strategy for the next 3 to 6 months?
As an allocation perspective, certainly I think one should move away from equities to bonds. Because now bonds are looking much more attractive. Even within the Indian equity market, I think bonds are yielding better compared to the equity valuation. Nevertheless, I think you can't completely get out of the market, especially given the strong economic growth outlook that we have in India. But I think within the equity portfolio, one can readjust from companies which are exposed to global slowdown to a domestic place. Those would be sectors like FMCG or the banking names, which could continue to do well given the strong economic recovery. On the other hand, sectors like technology or commodity names, they could come under pressure as the global slowdown continue. So one can, I think, readjust their portfolio within the local equity market. But from an asset allocation perspective, certainly more allocation to bonds right now compared to equities.
Okay. In terms of sectors, Suresh, I mean, since this is maybe a global slowdown, will themes also be global in that sense? One theme which has played out big time is IT, technology, which is markets are anticipating big time slowdown here for IT services companies as well. Accenture reported numbers, which was not all that bad. They just about met expectations, but business segments, etc., grew in a pretty healthy way. It's one large area in India which is down significantly. What's your sense, Suresh? Time to buy or hold on?
I think you will see a slowdown in the global IT service spending. Given the rapid slowdown we are seeing in the global economy, everybody is trying to cut capex, preserve their cash. And given that rates are going up, all the capex plans are on hold right now. So you will see slowdown from the global companies, which will impact the IT services companies in India. So I'm not bullish at this point of time, although prices have dropped quite a lot. But I think at this point of time, if you do see a bounce back, then it would be time to switch from IT services companies to local companies, which would be FMCG and banks.
Okay, what's your view on what's happening in the money market? You see in the bond market in a bear market for first time in decades. The dollar index is at 20-year high and is showing no signs of stopping here. And what kind of ramifications could it have for the equities?
I think earlier there was a narrative that Fed at some point of time will pivot from inflation to growth. But that narrative is dying now. And that's why you are seeing this big shift or big move higher in bond yields. The other factor which has happened yesterday is that BOJ's intervention in the FX market might have led to a selling of US treasuries by Japan. And that's why 10-year bond yield in US moved up 16 basis points. At this point of time, I think a large part of the rate hikes by Fed is already there in the price, but I don't think yields are going to come down. It's quite likely that yields will remain high for longer. And that will support US dollar. Because if you look across the board, the US is the one economy which could still avoid recession next year. Rest of the big economies like Europe, UK, they are really going to struggle. So short term, I think you would see further strength in USD, and that could lead to outflows from rest of the world.
Okay. So since your base case is that, there is a better performance in the bond market, so perhaps you're advising investors to move away from equities and into bonds. Do you fear that we could be headed for a big price correction in global equity markets, including India? Or are you just looking at a time correction now?
We are looking for some sort of correction in the global equity market, which will include US and EM. We went underweight on equities a month ago when S&P 500 index was around 44,100. Although our market is already down 10%, but you could see further correction. I wouldn't be surprised to see market reaching the earlier June low of 3640 for S&P 500. So you could see further correction. And for India also, I think there is a bit of pullback due, especially given the very strong performance. But that pullback might not last longer, given the strong economic fundamental. At this point of time, given the strong US dollar and the weakness that we are seeing in the US equity market, you might see outflows from across the world in equity market, including India. So I think a pullback is likely to happen, but it might not be longer or larger in India compared to the rest of the world.
All right, Suresh, we'll leave it there. Thank you very much for your time. It's always a pleasure having you with us here on the channel. Thanks indeed. Well, time for a quick break here. Up next, top stocks, which we are going to talk about with our research team lined up next in just a bit.
Welcome back, folks. The SGX Nifty has now moved to the low point of trade, down about 103 points. So let's see. It's going to be a bright shade of red this morning. But our research team is here to help you prep for the day and tell you what are the stocks to look at. Let's get to that very quickly. Anuj, what are you looking at today?
Sonia, clearly FMCG is something which is having a tailwind, and with crude also down to almost sub 90. I think you look at stocks like Pidilite, of course, rank outperformer. By the way, Pidilite and Asian Paints, if you notice the chart, they perform almost similarly on all time frames. So that's something I'll keep an eye on. Berger Paints has actually underperformed quite a bit compared to, say, Asian Paints. So I think that could be another stock that you could look at. If you see the 12-month chart, still down about 22%. Normally, this also moves in tandem with the Asian, so I'll keep an eye on that. But really, the sector of the morning or the stocks of the morning would be the metal stocks of the Tata Group. Late last night, actually early morning at 1 a.m., that board announcement was made. All companies merging with Tata Steel, Nigel?
Well, that's right. Anuj, the management has been speaking about this, that bringing all the entities under one, consolidated parent, and that's precisely what they've announced. So in terms of the listed space, well, we're going to be looking at Tata Steel Long Products, Tata Metallics, as well as TRF. They are the listed stocks that will be coming under the parent Tata Steel. Remember, as of now, on the consolidated entity, as it is, the financials, they get consolidated in because BSL, that's Bhushan Steel, has already been, consolidated into Tata Steel. A few factors at play now. The ratio should come up for you on the screen. For tin plate, it's bang in line. Now, Tata Metallics, normally the street wants to give it a higher multiple. Why is that? Because they're into ductile pipes business. Now, it's going to be merged into the parent. So because of the better parentage, I'll say that this is a positive. But otherwise, that business had, potential to get a higher multiple. For Tata Steel Long Products, no debates there. It's good for them, because you're sourcing your iron ore as well from there. For TRF, well, those that were buying TRF for the last 1 week, they have got caught on the wrong foot because the ratio that's come out is totally unfavorable for TRF. So expect that stock to be in the red. The others, I'm going with green out there. Just one quick point, pull up a last 1 week chart of both Tata Metallics as well as Tata Steel Long Products. For Tata Steel Long Products, it's positive and the street has sensed that. The stock is up more than 10% in the last 1 week. For Tata Metallics, though, it's down close to around 2.5%. The bottom line, though, is that there's going to be simplification of the group structure. Currently, they pay a higher royalty on the iron ore that they're sourcing from the parent Tata Steel. So that's around 100 to around 200 crores odd savings on a quarterly basis. And there'll be some synergy benefits as well coming out. So for Tata Steel, it doesn't move the needle that much. For most of the subsidiaries, it'll be green, while for TRF, it'll be red.
It'll be red for TRF. Nigel, thanks a lot for that. In fact, let's pull out TRF's 1 month chart. And, I want to say this for anyone who this morning is going to complain on, that this is not shareholder friendly for TRF. You had no business chasing this stock. Not Tata Materials. Just put out TRF's 1 month chart. In 1 month, it's gone up 138%. I mean, what exactly happened? From 163 almost back to 374, and now with this merger, it's actually 50% downside for TRF. It goes back to square one. So this is the danger of trading on back of the WhatsApp buzz that it's going to be extremely favorable for a lot of these companies. You bid up a stock like TRF, which has very low volumes, 5% circuit, and now the problem is that something which is a 5% circuit, on the downside, all you got to do is just keep seeing 5% down circuit till the time it gets into the equilibrium level where the value started.
It reminds me of what happened, the other one which happened yesterday, right, on the back of these binary things. Fortis. Yeah. I mean, it was a long time coming. The management had said that it was going to come, and perhaps there was no reason to expect that this will not go through. And of course, it was up to the courts always, but there was general build-up going into this particular one. And what happened yesterday? 14-15% lower. Fortis is what I'm talking about. And complete. The low was, I think, 255. It came up to about 265 or so by close. So be careful. Just absolutely. I don't know what people were buying TRF for, whether the buzz was out there, etc. Maybe it was, but as Nigel and Anuj said, caught on the wrong foot this morning. Well, let's talk about the IT space now, which also will be in focus. Rima is joining in to talk to us about Accenture earnings and what the implications are for Indian IT services companies. Rima, hi.
Hi, good morning. So Accenture Q4 numbers came in line with expectations and fairly strong. The key is their next year's guidance. The company has guided for 8 to 11% growth for the next year, and this is significantly lower than the 26% growth that they clocked in for FY22. But remember, Accenture typically starts the year with a conservative guidance. They've done that for at least the last 2 years in my memory. Last year as well, they started with about a low double-digit kind of growth, and they finally ended with 26%. So keep that in mind. The good part about Accenture's numbers is bookings were very strong, the second highest on record. And in that, outsourcing, which is a proxy for Indian IT space, has recorded 44% increase in outsourcing bookings. And the management said that outsourcing revenue will be in double digit. Where Accenture's numbers fell short was on the consulting side of business, and that is usually a discretionary spend. So it's kind of like a lead indicator that perhaps discretionary spending on tech side could come down. Nomura says guidance indicates demand moderation, but it's above pre-COVID level, while Kotak says the read-through for Indian IT in the context of lowered expectations, considering that generally the Nasdaq itself was down close to about 1.5%. Back to you.
Okay, Rima, thanks a lot for that. So we'll watch out for the IT stocks. But let's move on now. M&M Financial is in focus. Abhishek is here to give us the latest on that. Abhishek, over to you.
Morning, Sonia. RBI has taken action against M&M Finance. They have directed M&M Finance to stop recovery operations via third party till further orders. M&M Finance can carry out recovery or repossession activities through its employee base, which is around 19,750. So the management has responded to this. They have said that they have stopped third party repossessions, and they'll further examine whether and how third-party agents will be used in the future. We have a brokerage note coming in from Morgan Stanley, who have an overweight rating on the stock with a target price of 225 per share. They say that the impact on collection and asset quality will depend on the share of outsourcing that M&M Finance does. So alternate arrangements can be made. However, the length of time that this order will be in place, that needs to be seen closely. Back to you.
Okay, thanks a lot for that. So that's an M&M Financial, but lots of stocks in focus from the pharmaceutical space. Cipla and Glenmark on our radar. Ekta's here to give us more. Ekta.
Thanks for that. Well, with Cipla, I expect the stock to probably be in the green because their Indore facility has received an establishment inspection report from the US FDA indicating closure of the inspection. So that's possibly a positive. Glenmark, they have received an official action indicated status for Baddi facility in 2019. It was re-inspected in June 2020, issued 6 observations, and the company has said that the OAI, which is the official action indicated status, continues. Remember, they have a warning letter on this facility as well. So that still remains unresolved. Expect the stock to be on the red on account of that. But for Glenmark, an additional piece of news which could cushion the stock is that their Aurangabad facility has received an EIR from the US FDA. Remember, it was expected because it had received only one observation in the June 2022 inspection.
Okay, thanks a lot, folks, for giving us all of those ideas, all of those news points actually on individual stocks. Here's a quick recap in case you missed out on any of them. We'll, of course, discuss them with our guests as well through the course of the day. There's Tata Steel, Tin Plate Company, Tata Steel Long Products, Tata Metallics and Cipla, while stocks with negative news flow, TRF, M&M, Financial Services, TCS, Infosys and Glenmark Pharma. But there are some more stocks that could be in the news this morning. Vivek is here to fill us in on that. Vivek, good morning.
Well, good morning. Some of the other stocks, to keep on the radar. First up is Hero Motor. The company has announced that it would be hiking prices with immediate effect in various motorcycles and scooters. And the main reason or the main rationale, for this particular price hike is to mitigate the cost inflation that the company is facing. Keep an eye out for Bombay Dyeing. The company has raised significant funds, planning to raise almost 940 crores via a rights issue. We're also talking about Century Textiles. Now, Birla Estates, the company's subsidiary, which is involved in real estate, the company has gone ahead and acquired a land parcel as far as the Bangalore market is concerned. The company says that this potential land parcel is of 1 million square feet and has a revenue potential of close to 900 crores. So a significant development for Century Textiles. Keep an eye out for Shilpa Medicare as well. Some positive news flow coming in. The company's analytical services arm has got the US FDA nod. It has got the EIR, which is an establishment inspection report, which basically means that there are no adverse observations reported as far as the US FDA hygiene inspection is concerned.
Okay, thanks a lot, Vivek, for that. Let's slip into a short break. On the other side of the break, market expert Anand Tandon, Rakesh Arora of GoIndiaStocks.com and Vikas Singh of Phillip Capital will join in to talk about the mega consolidation that the Tata Group has announced of its metal companies, where it will amalgamate 7 of its metal companies with Tata Steel. Stay tuned for the complete analysis.
Welcome back. The stocks of the day today would be the Tata Group stocks. The board of Tata Steel has approved the merger of 7 Tata Group metal companies with Tata Steel. Listed entities include the Tata Steel Long Products, Tin Plate, Tata Metallics and TRF. We have 3 guests now joining us. Anand Tandon is joining us, a market veteran, Rakesh Arora of GoIndiaStock.com and Vikas Singh is joining us from Phillip Capital. Gentlemen, good morning. Anand, you have tracked this company for better part of last 3 decades. Sometimes I fail to understand what they're trying to achieve, but what's your view on this restructuring exercise that's happening now?
Sense for the metal companies to be together. I mean, perhaps it was an incident, a case of a different era where you had licensing and different kinds of issues which needed multiple companies. In today's environment, all that is not there, and there is absolutely no reason to have multiple businesses which are, in different stages, especially given the fact that GST impacts and taxes will actually cascade in some of these cases. So, to my mind, it makes perfect sense. The only question is of timing and the ratios that you will get, and I haven't had a chance to analyze that, so I don't think I can seriously comment on, whether all of them are being amalgamated in a way that protects the minority interest of investors. But otherwise, I think from a strategic perspective, it makes good sense.
I mean, actually, Anuj, so I've always wondered, right? So many companies listed, you don't know which is doing what. I mean, for the uninitiated, people who are tracking a particular company, that's fine. But I think I completely go with what Anand said in terms of just have one company. Anyway, all subsidiaries, all results are consolidated.
Exactly.
And I think it simplifies the business as well.
Absolutely. Rakesh Arora is also with us. Rakesh, good morning. You tell us, especially for Tata Steel shareholders, what does this mean? Good news?
So it's a long-term positive, as you guys have been discussing, that it cleans up the structure. But I think there's also a necessity to do this having acquired Neelachal Ispat and the Tata Steel long products, they have to make an investment of around $10 billion over the next few years. And there's no way Tata Steel Long's balance sheet can support that kind of investment. So either you have to infuse equity into a subsidiary and keep on increasing the holding company discount. So it doesn't really makes any sense. So probably they wanted to merge Tata Steel Long and then they cleaned up the whole thing. So it's long-term positive. Looking at the ratios, swap ratios, etc., I think market was aware. So most of the stocks are around that swap ratio, except for TRF where there'll be a big downside. So in the short term, there's no major benefit. Long-term positive and a necessity also, I would say.
Okay, Rakesh, good morning. Just one follow-up. You know, for a company like, say, Tata Metallics, right? I mean, it does get higher valuations because it's in the ductile business. Now that it's being merged into Tata Steel, for a Tata Metallics shareholder, if I wanted to be in Tata Steel, I would have bought the Tata Steel shares, right? But now, as a Tata Metallics shareholder, what do? Do you expect that stock to be under pressure because of this merger? What is the long-term outlook here?
No, so basically, see, Tata Metallic was taking iron ore from Tata Steel. So there are a lot of related party transactions. A part of, profits are going from Tata Steel to Tata Metallic. So I don't think there's any, major change for Tata Metallic shareholders. They are better off with Tata Steel in the long run.
Okay.
I mean, Rakesh, in a longer term, you need fewer. Operationally much easier, right? Fewer bank relationships and all kinds of things, right? I mean, operationally much more simpler. Would you reckon it amounts to not a very large sum in terms of savings annually for the group, or you think? I mean, tough to estimate, Rakesh.
So, Prashant, if you look at the minority interest of Tata Steel, it's around 1,500 crores a year. So that's like 7-8% of the profits. So it's not a big deal in terms of minority savings, etc. And there will be a little bit of savings from the administrative and overlap of functions. But see, already these companies are working like, different business segments, though they are different companies. So I won't really expect too much savings, but, as we were discussing, it streamlines the process and it streamlines the structure and also helps in treasury management, etc. So definitely there are long-term positives here.
Okay, long-term positives here. We have Vikash Singh joining in as well. Vikash, do you concur with Rakesh's view that long-term, of course, it's a positive, there are synergies, and some of these smaller companies are sort of, shareholders are better off, that these companies get merged eventually into Tata Steel. Is that your view as well?
Hi, good morning. So just I want to add one more thing. So from the near-term perspective as well as a medium to longer-term perspective, one obligation was also from the point of view that the MMDR Act has been changed. And Tata Long and Tata Long products as well as metallics are paying 22.5% additional premium on the iron ore, which has taken a big hit on the profitability side also. Since they have a plan to develop Tata Long products into a 10 million ton company and the iron ore would be supplied from the own mines, that is a 22.5% additional premium would have been a big consideration on the profitability side. So that is what I believe would be the long-term benefit for the company. Immediately, we don't see anything on a financial point of view changing, and as well as not much arbitrage on the smaller companies in terms of swap ratios.
Absolutely no arbitrage except that TRF goes down. Rakesh, just now since we have you with us, what's your view in any case on steel stocks and Tata Steel in particular? Because we had a massive rally, then a big decline, but over the last 1 month or so, we have seen some bit of rally once again, especially in Tata Steel.
So, Anuj, steel prices after correction from 77,000 to 56,000 have now stabilized. There was a little bit pop coming back in coking coal, which is supporting the steel prices. But I don't think there's going to be any massive rebound in steel prices in the near term because global situation is going from worse to worse. So I think markets demand restriction is much larger than the supply constraint that we are seeing in Europe, etc. So I would say that we have reached to a neutral territory. We are not yet positive at these levels.
Okay. Anand, what about you? You know, in the last 6 months, Tata Steel has lost, what, 25% of its value. Prices are under pressure. Demand is under pressure globally as well. Do you see any respite in the stock at all? And for the longer term, what's your view on Tata Steel?
Well, I've always tended to treat commodity stocks as commodities, so they are cyclical. You buy them when they are really down and out, and you sell them when they go up. So I would imagine that we've probably seen the peak in terms of prices. It may recover, as Rakesh was saying, a little bit, but given the global situation we are in and the intensity of interest rate hikes, I do not expect the demand will sustain even globally. So consequently, I think the price has peaked out. You're not likely to see a major. The best you can expect is that profits will kind of sustain a little bit in the region that they are currently, which means that from a stock market perspective, you could ease off considerably from these sectors.
Okay, fair enough. Well, Vikas and Rakesh, thanks a lot for your time today and discussing this this development. Anand, of course, we'll have some more questions for you. What about IT, Anand? Because we've seen a sharp correction. Accenture's numbers are almost in line, but the big worry is what's going to happen this year, because last quarter the worry was about margins, and now there are some worries whether top line itself would be under some pressure, and what happens to the valuations here on. Your views?
Clearly, margins will be under pressure. Even Accenture has, against what they guided last year, it has been a significant downgrade in terms of the guidance. So while they have done very well, it is likely that this current year will not be as good. And I think that is what the market is also priced in. You've seen almost, as you mentioned, almost 20 plus correction for most of the frontline companies. Given that we are now looking at a scenario where interest rates will be moving up, I think companies like IT services, most of the negativity is right now actually in big IT, which are product-based, which are based on, general business growth. IT services, I think, will have a lower rate of growth for sure, will have margin pressure compared to last year, but are in the context of the rest of the market are not particularly more expensive. I mean, they are trading higher than they should, but then so is the rest of the market as well. So from my perspective, I think I would still remain moderately underweight if you really want to take a position which is very sharp. Otherwise, a market position seems to be merited.
They're merging all this in the steel business, Anuj. On the IT side also, will we see, right? They've got Tata Elxsi, they've got TCS.
Yeah.
What else? I mean, I can't think of immediately any other line of businesses where they've got more than one company and eventually, they kind of bring it together.
Actually, that's the biggest risk. For Tata Elxsi, for longest, the only risk is if it gets merged into TCS, because, Tata Elxsi has been the most remarkable stock in the mid-cap IT. And, while all the IT stocks have corrected, this one hasn't. I mean, there's still something which is holding, I think, so far high, because it's in artificial intelligence and a couple of other really booming sectors. So you don't want to be merged into something which is growing at 3%, while you yourself are growing in the high double digits. Even
the base, I mean, TCS, of course, I mean, just in terms of sheer absolute revenues, etc., is top of the food chain. So to grow on a base of that will be very different. But even standalone Tata Elxsi, to be the flip side is it's already trading at what, 90 times 1 year forward earnings, 90. So, you are paying top dollar for that. But anyway, that's a different debate we are getting into. The question is, will we see this happening with Tata Group companies and other sectors like IT services, etc.? Anand is with us. Anand, hi, good morning. Just a quick word on Fortis with the big correction we've seen. The open offer will not go through. There is a stay. And Ekta was yesterday telling us that will IHH, is it possible they get frustrated and put this asset on the block? We don't know. Those are answers we don't know yet. But the company keeps operating. I mean, the CEO and the managing director who runs the company is appointed by IHH right now. So the operations continue as it is. The stock's down about 14-15%. Would you give it a look, your sense?
Well, obviously, you will only get this because there is a lower valuation only because there is some confusion in terms of ownership and the likely future movement. The key question is whether the company is going to be viable and continue to grow and raise money. If it is able to raise money, I see absolutely no reason. Hospitals are a great place overall. And therefore, given the fact that it's not probably as expensive as some of the frontline ones, there may be some play still there. I don't see any reason why you should be moving out. I think even if the current ownership were to move out, there will always be some other taker for that. So I think so long as the operations behave reasonably and there is no cash flow issues, I think it's a safe place to be.
Okay, so let's do one thing. Let's take a quick commercial break on that note, but lots more coming up on the other side. Mitesh Thakkar and Shrikant Chauhan will join in for some technical trades. Stay tuned.
Welcome back. Well, like we've been pointing out, the global market is going through a bit of a risk-off. The SGX Nifty is down 91. Yesterday, the market recovered quite a bit, almost came in the green, and then had that second decline. Mitesh Thakkar and Shrikant Chauhan now joining us. Good morning, Mitesh. Has the texture weakened now? Is this now a sell-on rally market instead of the buy-on dips, or is the larger impulse still to buy the dip?
Morning, Anuj. My understanding is that this is not a directional market. We are still in that contracting phase, and we have been there since for about 3 to 3.5 weeks now. And broadly, if you see, during that time we have had two highs, one at about 17,965, the other one at about 18,015. So just about 50 points apart. That's only 0.3%. And broadly, holding around the 17,400 marks. So it still looks like a broader consolidation range. I don't think I'll be looking at directional bias because a lot of volatility indicators, directional indicators are still flat. So I think this market will continue to amble around at least till, till the next few days, which is about 5 to 6 days at least. And then we might get a directional bias. So for the timing, the idea is that as you head towards the lower end of the range, try to look for long positions, which is closer to about 17,500, 17,400 zones. Go long. Closer to about 17,850, 900, start booking profits. And if you go slightly higher, maybe even attempt short. So that's the way I think traders should approach the market.
Okay, that's a wide range. And Bank Nifty, Mitesh?
Yeah, on the Bank Nifty, I think the Bank Nifty made a fresh high and then is now giving a pullback to the earlier high. So this 40,300 to about 40,000 zone is a very important zone. If that holds and we get a reversal, then I think the Bank Nifty will be the first index where I would attempt a low. But I think this 300-point range should hold out.
What about individual stocks then? What are you looking at?
I have a mix of buy and sell calls. Couple of FMCG names on the buy list. Britannia is a buy with a stop at 37.75 for targets of 39.50. It's been a buy earlier as well. HUL is buy with a stop at 26.70 for targets of 27.45. On the sell side is ONGC. Keep a stop at 131. Look for targets of 122.5. And Muthoot Finance is a sell with a stop at 1,031 for targets of 975.
Okay, Muthoot, I mean, what a reversal it's been. It used to be the strongest NBFC after Bajaj Finance, and all of a sudden, just one of the weakest stocks that we have right now. Both Muthoot and Manappuram, actually. Shrikant, good morning. What is your index trade, and if you could give your stocks as well?
Good morning, Anuj. Good morning, everyone. I think, see, for the Nifty, multiple headwinds are not allowing the market to cross the level of 18,000. And till the market is not breaking the level of 17,400, where the market is having ultimate support, we are going to see range-bound activity. In case if we see the market is breaking the level of 17,400 in a hurry, then we may see the levels of 17,000 or 17,150. But till the market is above 17,400, we are expecting market to remain range-bound and we need to focus on stocks. For the day, specifically, we are going to focus on mid-cap IT companies because the currency is depreciating and the dollar index is above the mark of 111. So in that space, we like Coforge, which is currently around 3,400. There we can keep stop loss at 3,350. The stock is forming double bottom sort of formation. And most of the time, whenever we see some weakness or specific weakness for Indian rupee, we see some activity in mid-cap IT companies. So Coforge, we are expecting to move towards 3,600. And on the short side, we are expecting HDFC to come down to the levels of 2,350 or 2,330. Currently, it is at 2,400. We should be on the shorting side, on the selling side with a stop loss at 2,440.
All right. Shrikant, thank you very much for that. And Mitesh, thank you very much for joining in as well with those trading ideas. We'll take a quick break here. We'll come back with a pre-open that's about 6 minutes out. And we have a big guest joining us. Kaushik Chatterjee of Tata Steel is going to be with us to talk about the merger of the 7 Tata Group metal companies with Tata Steel. the rationale behind this and what from here. Stay tuned for that interesting conversation in just a bit.